This video could save you tens or even hundreds of thousands of dollars in capital gains tax. If you want to reduce or even eliminate capital gains tax, you definitely keep watching. In this video, we'll go through how capital gains tax works on investment properties, and 4 ways to reduce your capital gains tax, and 3 common mistakes investors make, and how to avoid them. Hi, my name is Eric Lee. I'm an accountant with 15 years of experience, and I became a real estate agent as well to help people to build wealth, not just prepare tax returns like most accountants. With your expertise, I help property investors in everything from setting up tax-effective investment strategies to acquiring high-performing properties. Unlike online gurus, I uphold the highest standard as an accountant, helping people to avoid costly mistakes. So, if you want to learn about property investment, hit that subscribe button and stay tuned. Alright, let's start with the basics. Capital gains is basically a profit from a sale of investments, and most common examples are properties and shares. And there are separate tax rules that apply to this particular type of profit, and we call it capital gains tax, in short, CGT. How CGT works at higher level is like this. You sold a property, then all the numbers like a purchase price, sale price, acquisition cost, and selling cost go through the CGT rules and calculations. Then we have capital gains or loss. If you have made capital gains, then the gain will be added on top of your other taxable income and taxed at your marginal tax rate. Unlike some other countries, CGT is not payable separately but forms part of your tax return of the year that you sold the property. What if you made losses? You can use it to reduce your other capital gains like profit from sale of shares, etc. Or if you don't have any other capital gains in that year, you can carry forward to reduce your future capital gains. Unfortunately, capital losses are not part of your negative gearing calculations, and it can only reduce other capital gains. You cannot use this to reduce your other taxable income like wages, business income, etc. Now for the good part, how to legally reduce CGT. Firstly, the 12-month rule. If you hold a property for more than 12 months, you get 50% discount on capital gain. This is huge. You know what? This is one of the reasons why the rich people invest in properties. You think about it. During the ownership of the property, they benefit from negative gearing, which means every single dollar, 100% of the money they lost is tax deductible. But when they sell the properties, they pay capital gains tax on 50% of profit only. Secondly, you can avoid CGT as a whole if the property you sold is your main residence. And this is called main residence exemption. The main residence is a dwelling that you and your family live in it. Your personal belongings are in it, and it is the address your mail is delivered to. If you only have lived in property partially during the ownership, it gets a little bit complex. Because the main residence exemption only applies to the period you actually live in, and you need to take various facts into account if this is the case. So, if you are in this position, speak to your accountant. The third one is connected to the main residence exemptions we just talked about, and it is 6-year rule. Basically, ATO allows you to continue treating your former home as your main residence for up to 6 years after you move out. Even if you're earning rental income, it still applies. The good news is that this rule can be applied multiple times because this 6 years gets reset if you move back into the property as your main residence again. But remember, you can only elect only one property as your main residence for the same period of time. So if you purchase another property as your main residence after you moved out from your previous home, you have to choose which property you want to treat as a main residence. The last one is about timing of sale. Since CGT is added on top of your other taxable income in the year of sale, selling in low income year, like when you've retired or taken career breaks, could save you CGT. Be aware that in most cases, the date of your sale is not a settlement date, but contract date. So you signed the contract of sale on 30th of June 2024, you have to report the capital gains in 2024 financial year, even if the settlement took place in August 2024. Not finished yet. Hold on a sec. Even if you've done everything I just said, if you make these 3 mistakes that I'm about to tell you, you get screwed. The first mistake is failure to keep records. Like any other taxes, CGT is all about proof. And the proof means documents and records. You must keep records of purchase costs, stamp duty, renovation costs, legal fees, and selling expenses, etc. No paperwork, no deductions, period. The second mistake is messing up the timing. If you sign sale contract on 364th day from your purchase contract, you lose 50% discount. I have seen actual cases that people made this mistake because they thought the date of sale is settlement date, when it was actually the contract date. A few days of difference, but tens of thousands of dollars loss. Lastly, it is about not getting proper professional advice. There are many more moving pieces that I didn't cover today when it comes down to property investment, including ownership structure, like which name you should buy property under, personal name, trust, or a company, and what are the legal and tax consequences of each structure, and lending strategies to maximize your borrowing capacity, etc. And also, competent professional will help you not to miss any possible exemptions and concessions that may apply to your situation. As an accountant with more than 15 years of experience, I can tell not every accountant has the same level of expertise in property investment. So, you may want to do your own due diligence to find the one who can provide you with the best services to maximize your benefit. Being ignorant or having advice from incompetent professionals could cost you a big time. So, there you have it. CGT doesn't have to eat away at your profit. With the right strategy, you can legally reduce your tax bill and keep more of your hard-earned money. If you found this video useful, hit the subscribe button so you don't miss out any future updates. If you're looking for a property investment specialized accountant, you can contact me using the contact details below. Thanks for watching, and I will see you in the next video. Bye for now.